Hello everyone, welcome back to part 3 of the video series for Course 101 Introduction to Futures Markets. Part 3 of the video series focuses on rolling contracts, so we will dive into why traders look to roll contracts, what does it mean to roll a contract, how is it done, what's the utility, what's the purpose. We'll cover all those topics, but first, everything discussed in this video and all content on marketmentor.io is for educational purposes only. I am not in any way providing financial advice or soliciting financial products. Trading futures markets carries significant risk and can result in loss of capital. So we'll turn our attention right now to the book, Chapter 5, titled The Roll. Covers this topic in depth and should assist in fully grasping the topic, but having a visual demonstration here will be helpful in really solidifying your understanding. So let's stick with gold as we have been here to keep it consistent. We'll look back at the CME Group website, the Gold Futures Settlement page, and we remember that August is the front month. Today is July 30th. So August is the front month contract, and the last business day of the month prior to the contract month is the first notice date. So tomorrow is Friday, July 31st. That's the first notice date for the August 2020 futures contract. And the first notice date is significant from a trading perspective, as any market participant with an open position in the August 2020 contract is subject to being called to make or take delivery of the underlying asset. And remember the futures contract specifications. Each gold futures contract on the CME is the equivalent to 100 troy ounces of gold. So unless you have the capacity to take delivery of 100 troy ounces of gold per contract held outstanding, or unless you have the capacity to make delivery on 100 troy ounces of gold per contract held outstanding, you as a trader would want to exit that opened position on an August 2020 futures contract prior to the first notice date to alleviate the risk of being called to make or take delivery on the underlying asset. And futures contracts are split into two types of contracts. There's financially settled contracts and physically settled contracts. A financially settled contract, you don't have to worry about taking or making delivery, as the contract will go into its termination of trading date and you will be marked to market against your open position relative to the final settlement price and simply settle up in US dollars. However, if you are trading in a physically settled futures contract such as gold, you are subject to make or take delivery if you are a holder of that contract through first notice date and into the termination of trading date for the contract. So to jumpstart this, we're going to go back into TT and pull up some gold markets. I'm going to pull up the August contract for gold as it's about to go into first notice. So we'll pull up August here, and then let's just pull up October, which is the next most liquid contract, and we can confirm that by revisiting our settlements page on the CME website and noticing August, prior day open interest and estimated volume numbers. Then you can see September, very light. So the next most liquid contract is October. You could also roll into December, and we can show that as well. But October would be the next liquid contract that a participant could go into. And for the sake of education, you could theoretically roll into September as well. Traders typically do not roll from highly liquid contracts into lightly liquid contracts, but theoretically you could do that. So back to TT here, we are looking at our two markets, and we're going to demonstrate what it would look like for a trader who is long a GC gold August 2020 contract. So we're going to buy a contract, and I'm going to go look at my positions, and I see that I am net long one contract here. And if I look further into my positions, it is a GC August 2020 contract that I am net long. And as a trader long this contract on the day prior to first notice, I'm particularly interested in either offsetting the position in the same contract month to go get flat the market, or if I want to maintain the position either as a speculative trade or as a hedge for treasury risk management. If I'm a buyer of gold, for example, for whatever reason, then I can do so by selling my long one GC August 2020 futures contract and simultaneously buying one GC October 2020 contract. That would remove my risk of being called to take delivery, and it would maintain my hedge based on the relative value of the two contracts into October 2020. And I'm going to demonstrate this manually to show you how this would look. So I'm going to place a sell order in the market, and let's see if the market takes it. Okay, it took it, so now I'm going to immediately buy October. And if we come down to my position window, I can see gold GC August 2020. I am net flat, net position 0. Gold October 2020, I am long 1. So I've maintained my position, and that's the point of the roll. So that is how a trader who is long the near month contract heading into first notice date can exit that position, remove the risk of being called to take delivery, but maintain a long position in gold futures markets by simultaneously buying the gold October 2020 contract. And for this video, we will now get flat and demonstrate what it would be like to be short the contract and looking to maintain that position into first notice. So if the market fills me here, I am now short one GC August 2020 contract as a trader for whatever reason I'm short, either speculatively or systemically, and I am going to look to roll this position from August, which is heading into first notice date, and go into October maintaining a short position. So I do not want to be assigned to make delivery on my contract. I don't have 100 troy ounces of gold, or I am looking to maintain the position for whatever reason. So the rolling transaction here is to buy GC August 20 and simultaneously sell GC October 20. So I'm going to buy the market here in August, and I'm going to simultaneously sell the market here in October. If the market didn't take my order there, this is one of the risks of executing manually, which we will touch on in a second. So I might just move this order down to speed things along. Let's give it a sec. Okay, there it filled me. And you gotta remember we're in simulation here, so sometimes the data and the ticks are a bit delayed. But so now if we come down to my position window, I look, my gold August 2020 net position is 0, it is flat, and my gold October 2020 position is short 1. So we have done what we've set out to do. We've rolled our short position in gold August 2020 ahead of the first notice date into gold October 2020. Now we saw just there, as I was short the August contract and I was attempting to roll into October, we saw that what we call hang risk, which is the inability to execute my second leg of the trade at the desired price I was looking to do so when I executed leg 1 August. So that order was sitting in October. The market could have kept going lower, and I never would have been filled, and I would have had to chase the market down, and that's just more negative P&L in rolling the contract. So to avoid that, we can open up the calendar spread market. And this is now another way we can see some practical application of why a calendar spread market even trades, or what's the point of them, or what's the function. Well, this is one of the functions, so that traders can roll contracts at a defined price. So I'm going to open up my gold August 2020, gold October 2020 calendar spread. We see it's very wide and very illiquid at this point, getting so close to gold really not being traded much after first notice. But for educational purposes here, we're going to demonstrate rolling a long contract with the calendar spread market. So here we notice in the position window that I'm long one. I got to flatten my October for this example. So I am going to flatten October here. Yeah, so now I'm long one gold August 2020 futures contract, and I want, as a trader, to roll my long position from August into October. So instead of doing what I just demonstrated, a manual roll, which some traders may choose to do for whatever reason, I can use a calendar spread to define the price that I'm going to roll at, instead of taking the risk of executing this thing manually. So if I know I'm long a gold August 2020 contract, and my goal is to roll the long position into October, which would be selling August, buying October, I know I can look at the calendar spread market, and if I hit a bid here, if I sell this calendar spread at minus 12.1, I'm going to be selling August and buying October. And I can define the spread price. I'm going to be paying $12.10 in premium on the October contract to roll my long August position. So let's execute that trade right now and watch our position window down here, the gold August and October. Let's watch how it changes. So I'm going to hit the market. I'm going to hit the bid here, and in simulation sometimes this just doesn't want to execute. There we go. So now you see that I have rolled my position. So I have gone from being long August to now being flat August and long October. And this trade was done using the calendar spread market instead of manually executing between the outright markets. So very large hedgers in the gold market would be prone to utilizing the calendar spread market and defining the price that they execute at. This is a critical component of why calendar spread markets are at play. And let's now get flat this October position, and I'll demonstrate the other way around. That should have filled. This is as I've been mentioning, the issue with operating in a simulator. Let's just see if we can get out. There it goes. Okay, so now we can see that we are flat our gold August and gold October positions. So that's the goal we were trying to do there. Now let's get short the August outright and demonstrate utilizing the calendar spread market to get out of the short August position. Let's see if this thing clicks here. There it goes. Okay, so I'm short an August contract, and to utilize the calendar spread to roll my short position, I need to, number one, buy this August market so that I can go flat August, and I need to simultaneously sell October. So if I come to the calendar spread market and I look at the offers here, if I buy an offer, if I lift an offer in the gold August 2020, October 2020 calendar spread market, I am buying August 2020 markets and simultaneously selling October 2020 outright markets. So let's go ahead and try to execute this roll, going from short August to short October. See if this executes. Sometimes it just takes a minute in simulation. It's very odd that it's not executing. Typically, we don't see an issue like this as we test strategies. There, okay, there it goes. So for whatever reason, the simulator's data is just delayed. But now if we look at our position window, we see gold August 2020 is flat and gold October 2020 is short 1. And we were able to achieve that roll, that the going from short August 20 to short October 2020 by buying the calendar spread. So that is a great example of how to utilize these markets and how to understand some of the dynamics that are at play towards the end of each calendar month in multiple futures markets. And looking at these spreads is just another way to gauge, what is market sentiment, where are buyers and sellers at, what's going, what are the internals of these markets, and that you can build on this internal perspective on top of liquidity analysis and market microstructure that we talk about in course 201, building statistical arbitrage trading strategies. So lots to absorb here and lots to digest, but these are fundamental principles that can really accelerate your understanding. So let's see now if we'll still get delayed data. It sure seems like it, but not so bad. We're going to be flat everything here. And we're going to briefly talk about, we're going to go to the book for a minute, and we're going to visualize, what the role is. So in our example in the book, we use the Bitcoin market, and Bitcoin happens to be financially settled, so the contracts can be traded until the termination date. But this is an example of a snapshot of the settlements tab on Bitcoin on the day prior to the January contract rolling off the board or going off the board. So trader, if we look at the graph down here, we will notice January is no longer there and July has come on the board. So that is a contract that people and market participants would be looking to roll out of ahead of the contract going off the board if they seek to maintain their position. So this is an example of when a futures contract stops trading. That next trading day, you no longer see the contract you were just in on the board, and they've added a new one. So you're either going to be marked to market on your position for your open position on this contract, or you're going to roll it into February or into March or into April. And it's the same is true here on this gold settlements tab that we're looking at. August eventually will come to a termination date and will no longer be on the board. And at that point, nearly everybody who wants to maintain their position is already into a different contract month through a rolling trade. And to broaden our view on rolling trades from August, October, we can take a quick peek at doing August into December on a roll. So we'll open up the trader, MD Trader here, GC DECE, and we will change this market to GC DECE as well, GC August DECE. just had to take a look for it. August, December. Here it goes. So here's the calendar spread for August, December. Let's get long the August contract. Now, how do we get out of that? As we know, we can either sell August by December manually, or we can come to the calendar spread and sell August by December to roll our long. Let's see if this one works. Worked there. So now we look at our position, and August is flat, and December we are long 1. So we'll get out of December and demonstrate the other way around here. Let's sell it. Okay, now we're flat the market. So let's go short August. Let's chase it down. We're short August. How are we going to get out of a short August position into a short December position? We're going to buy the spread, buy August, sell December, and there it goes. If we look at our positions, August is now flat, December is now short 1. So I hope this is helpful in grasping the roll. And what we can do now is go back to the book and explore one of the most interesting things that has happened in futures markets or financial markets in general in the past 100 years, which was the oil futures market crash in May of 2020, where futures prices actually went negative. So let's look at this chart for a sec and digest what we're seeing here, as it's absolutely insane. So the May 2020 futures contract, this is back in March, April. This is when it crashed. That's May. That graph's a little goofed up. The contract was trading at plus 40 and ended up trading down to negative 37.63. Most people weren't even aware that contracts could go negative. The CME had to scramble on it on some PR stuff that was being worked. But the contract can in fact go negative. And why would this happen? Why would a contract go negative like this? So if we look at the prices here, the May contract, May 2020, went to negative 37.63, but the June 2020 contract barely budged. We're talking a couple bucks, maybe $10. This might be 30. It's probably like 27. So talking $7. This thing moved, while the May contract moved over $50 and went negative. So what happened here? It can be thought of from the perspective of rolling contracts. So let's open up some crude contracts just for this example. So we're going to type in CL is the product code for crude, and the front month. We can do SEP for the front month. Yeah, there's a market there, and we can do October for leg 2, and then we can pull out the calendar spread for leg 3. CL spreads SEP-OCC. SEP 20 October 21, we're looking for SEP 20 OCC 20. There it is. Okay, here's the calendar spread for SEP 20 OCC 20. If we think of SEP as May and OCC as June, we can kind of begin to piece together how this thing happened. And let's assume that we are long a SEP contract here. Look at our fill window here. We're long 1 CL SEP 20. And now let's think about the scenario that played out in one of the craziest financial market events in history. The May contract goes negative here, while the June contract barely budges. So, let's first off take our knowledge of calendar spreads and let's think about what happened to the calendar spread market. So, prior to the crash, let's call gold, or let's call oil. May was trading around, $18, maybe $17 right before it really took a plunge, and you've got June markets trading at 21. So you're looking at a between $3 to $4 calendar spread, um, on the on those two markets, which I don't have the historical data in front of me, but I think even that is wide. And remember, wide is in a contango market is a greater negative number. So here we're at minus 30 cents mid market. So we're saying that before the crash, that calendar spread was all the way down here at -3, -4, range, between the CL May and June contracts. Here we have SEP and OCC to demonstrate. So that calendar spread, at the bottom of the market, went out to minus 58, it's almost minus $59, and that's just an incredible move for a calendar spread market. It's almost even more unbelievable than the outright move, for a calendar spread to go that wide that quickly. It's just devastating to those who are on the wrong side of that, and extremely rewarding to those on the right side of that move. So let's think about the position. If you were long the front month contract here, we're long one SEP in this example. We look back at the chart here from the crash. Let's say you're a trader and you're long a May contract, and you're unable to take delivery of crude oil. So one thing to keep in mind is this was the heart of, this is the end of April, because it's the May contract going off the board, and this is the first month after the COVID-19 economic just halt. And what began to happen is oil tankers and oil storage facilities and the massive intercontinental barges that store oil on the oceans and transport oil back and forth between continents, they all were filling up. I mean, traders were buying oil, and they had nowhere to sell it, so they're storing it, they're pumping it. Every storage facility in the oil market, especially in the spot looking for a home, was full. So if you were a futures contract trader and you are long a May 2020 futures contract, if you hold that thing into expiration, you have the obligation to take delivery of crude oil. Now, the crude oil futures market is full of participants that don't have the capacity in normal times, in normal market times, to take delivery of crude oil, let alone in a cataclysmic event such as what we saw in the month following the economic shutdown due to COVID-19. So that only increased the number of participants who were holding a May contract long that needed to get out because they could not take delivery of the crude oil, and they had nowhere to put it. It's worthless. Crude oil is worthless if you can't store it and you can't send it to a refinery. So these traders who were long the front month contract, they had a pretty tough decision here, as the market was screaming lower on them. So here's the market's at 40. Let's just start to scroll through, and the contract specs on crude oil are $10 a tick. And most of these types of traders are not holding one contract, they're holding hundreds, if not thousands, of contracts. So as I continue to scroll, I'm only at $36 here from 40. So you can imagine, just how drastic of a move this market was making in real time. And so the the reason for the crash is that any buyer in the front month contract was just gone. There were no bids. The market looked like this, and you had sellers just chasing all the way down, trying to get flat the May 2020 contract. In this example, I'm scrolling through September 20. There's just people who are long looking for a buyer, and there's no buyer anywhere. So, where do you have to go in the market? Where will someone buy your long contract from you to get flat? And so the traders just kept chasing and chasing and chasing and looking for bids, looking for bids. There were none. So that's how a market goes negative. And now to bring the June contract into play here, so we can notice that the price of June oil barely budged, especially relative to May. And if we think about the calendar spread as one way to get, I'm going to show you the roll here. One way to exit that long position is to sell the calendar spread. And now if I look at my positions here, um, uh, I am no longer long the SEP. I should be short. Right, yeah, I'm long October. So I went from leg one, long leg one, to long leg two here. You see I'm long October, I'm flat September. So a trader who was long the May 2020 crude oil contract could sell the calendar spread. They could sell the May June calendar spread, in this example the September OCC calendar spread. But as you can see here, even the calendar spread was blowing out. As we just discussed, it went from maybe $4 a spread, which is still steep, down to negative $58. Almost negative $59 a contract. So here you see I'm at negative 31 cents. I mean, imagine these traders trying to get out of a long May contract through the calendar spread, and there's just no bids. Every bid is backing up, and for every single tick, as we know, it's $10 per contract. So where can a trader who is about to be requested to take delivery of crude oil that they have no capacity to take, where can they sell that contract to somebody? Where will there be a buyer to take away their obligation to take delivery on the underlying commodity? Because crude oil is a physically settled futures contract. So as we can see, I'm still scrolling here. I'm down to -8, but this thing blew out $58, $10 a tick. So this is just an example of the devastating effects of, number one, holding a futures contract in the week up to first notice, or even to the day up to first notice, as many people were doing there. And it also shows you kind of how rolling contracts played into this historic event, really, for futures markets. And now that you can understand rolling contracts, you really have a firm grasp on what caused one of the most significant financial market moves in the last 100 years, and probably farther. So hope that's a helpful analysis of of the roll, and how traders utilize it, and why they would utilize it, and what the purpose of the transaction is. So thank you.